Hello and welcome to this brand new edition of MF Corner. I'm Sonal Bhutra in the Mumbai studio. Now, as per the latest circular, Sebi has allowed mutual funds from FoFs investing in overseas category to invest in overseas funds while they can hold some Indian assets as long as these Indian assets don't make up for more than 25% of the fund's total investments. However, if an overseas fund exceeds the 25% exposure threshold to Indian securities, the Indian mutual funds must refrain from new investments in that fund and may eventually need to divest. That sounds very technical, but to make it simpler for you and to understand it in even more detail, we have with us Shweta Rajani, the Senior Vice President and Head of Mutual Funds at Anand Rathi Wealth. Shweta, good afternoon. Thank you so much for joining in today. And this circular came by recently, Sebi allowing mutual funds to invest in overseas funds with exposure to Indian securities. Let's break it down and try to simplify it for the viewers. What does this exactly mean and how does it differ from the older regulations?
Good afternoon, Sonal. Like you said, it sounds very complicated. It's not really that complex. So, let me break it up and first talk about what was the earlier rule. So, Sebi has a master circular on mutual funds, and in that there is this section, called 12.19. And if you refer to that, it talks about the overseas investments limits for mutual funds. Okay, so point one, mutual funds can invest in overseas equities, and the limit that RBI had allowed them was $1 million for each asset management company, and overall at an industry level, $7 billion of investment. That's the overall limit. Now, where can this money get invested? So there are a list of securities which Sebi allows them, and the earlier circular said a mutual fund, a domestic mutual fund, if investing in overseas funds or equities, can invest in, let's say, the listed securities of a company. You can invest in an IPO of a foreign company. You can invest in foreign debt, be it company, government debt, ADRs or GDRs listed by Indian companies abroad. So there are a list of securities. And finally, the final security mentioned there was a domestic fund can invest in units of overseas funds which invest in overseas equities. That was the earlier rule. Now, clearly, there is no clarity on this because it does not talk about what if you have an overseas mutual fund which invests in Indian equities. Can you or can you not participate? If you can, to what limit? So this circular, which came in 2 days back, now says that apart from the earlier securities or securities which were mentioned, you can also invest in a unit of an overseas fund which may have less than 25% exposure to Indian equities. So in a way, it now allows you and more diversification, more avenues to invest in overseas equities with some exposure to the Indian market.
Okay, so that makes it simpler. This is the change that has come by, something that was already allowed. Now it is with some limits, and you can allow investing in a fund which has some exposure to Indian equities as well. What is the impact on a fund house because of this? Is it a big positive that has come by for them?
Definitely, this is a positive for the funds because if I just have to list down earlier, this was a little hazy. You did not know, and if any AMC wanted a clarification, they would individually go to Sebi, seek approval, and go ahead and do an investment. Now there is complete clarity of what you can invest to what limits. There's more transparency. Even as an investor, at what could be the extent of investment. Third, by allowing this limit of not more than 25% in Indian equities, somewhere there is more regulation coming in. You are kind of avoiding, putting a limit to round tripping. If there was this limit was not there, let me give you an example. Let's say there's a BlackRock or a Prudential flexible equities fund, which is investing globally. It has 50% exposure to Indian equities, and a domestic overseas fund has invested in that. Effectively, indirect exposure to Indian equities is 50%. So your money went out, assuming you're investing in international equity, it comes back into India. Now, that would be stopped because you'll have not more than 25% exposure to Indian equities, even if you've participated in an overseas fund. So this is definitely a good thing for asset management companies. However, we may not see an immediate impact of this to the AMCs because most of them are very close to that $1 billion limit. And they're not investing too much in overseas equities today. So immediately, no. Long term, it's definitely a positive.
Oh, yes. So that has been the problem for the international funds so far, right? All of them breaching that limit that the RBI has suggested. But let's talk about it from an individual investor level. Suppose that limit was not there and suppose that benefit does come out few years down the line. What does it mean for them?
So, again, I would say from an individual investor perspective, this is positive. One, because it helps you diversify. So, let's say you wanted some India exposure, you wanted some global exposure. So now just buying one overseas fund, you can have that advantage of getting exposure to more than one country. So it brings in diversification in your portfolio. Second advantage of diversification is a better risk management, correct? So you would get exposure to different countries and therefore lesser correlation. So, you bring down your overall risk. It gives you an opportunity to participate in better performing countries and therefore, a better return coming into your portfolio. So these are few advantages. Apart from these advantages, one thing that, because now it's mentioned in the circular, it's a part of the regulation, that there is more tracking by Sebi, more vigilance. So again, from a regulation standpoint, it ups the ante.
Okay, but is this something the industry had asked for, or is there some more that needs to be done in this space?
So this is, definitely a need from the mutual fund industry as well. So if you read the circular, it said that this was something that came in from opinion from the public, from the industry as well. Because like I mentioned, earlier individual AMCs would go seek clarification from Sebi, and each may then end up doing their own thing because it was a gray area. So this was something that the industry was looking forward to. Of course, what more can be done in this? One is clearly a relook at the overall limit is clearly needed. Second, while this regulation comes in today and it allows up to a 25% exposure to Indian equities, it gives you a 6 months of window to rebalance also. So if you've breached that 25% limit within 6 months, you have to come, you have to correct your positions. I think what more would be needed is in terms of country-wise exposures that are allowed or not allowed. So yeah, some more needs to be done, but I think good one step forward.
Okay, good one step forward. The other part of this circular is that the regulator has barred advisory agreements between Indian mutual funds and the underlying overseas mutual funds. What explains this? Is this a very important point in the entire scheme of things?
Yes, this is very important and very critical because, when you're saying that you cannot have an advisory agreement, what it means is, I'll again try and put it very simply. Let's say you have a fund manager in India who's managing your overseas equities, and you have an entire fund management team who's also responsible for your Indian equities. Now, as a fund house, you participate in an overseas fund, and you become the advisor for you advising them on where they should invest in Indian equities. There could clearly be a conflict of interest. So by allowing, by not allowing this advisory relation between the domestic entity and the international entity, you're actually avoiding conflict of interest, which is very good and very important because now you have two independent fund managers taking their decisions, which are in the best interest of the client. Nobody is influencing anybody's decision, and therefore, it would mean more efficiency in the way the portfolio is being managed.
Okay, makes sense. And thank you, Shweta, for joining in and explaining this new regulation so clearly to us. Very helpful and makes sense of what's happening in the industry as well. Thanks a lot for joining in. All right, with that, we'll take a quick break. On the other side, we'll discuss the impact of Trump's victory on international investing via mutual funds, where you should look at, and a lot more with Harshvardhan Roongta, CFP at Roongta Securities.